Good afternoon, everybody. Welcome back to the weekly market analysis for the week ending March 15th. It's the Ides of March, and I'm wondering today if this is a buyable dip or if this is the beginning of a bigger correction. And we'll get into it in just a little bit, but I want to remind you first to hit the like button and subscribe to the channel if you haven't already. You can also follow me on Twitter at Mr. J. Thomason. You can also go to my free weekly newsletter, subscribe to this. In 2024, it is absolutely free for all of the analysis that I offer. You can find the links to both my Twitter and my Substack in the links below in the description of the video. So we'll jump right into this, looking at the S&P 500 futures. And today, just for everyone, the numbers I'm usually looking through the futures because that's usually what I trade. And for this, I'm going to do something. I go back and forth on this. Sometimes you'll notice that on the bottom right side of my screen where my mouse is flipping out, it says B adjust. And so what this does is it adjusts the chart for contract changes, because what happens every quarter on the equities and then on different asset classes, it's for futures, it updates it sometimes monthly, sometimes quarterly, and so on. But the futures contract roll will happen, and just briefly what that means is so that the March contract actually ended today, and for the S&P 500, but was rolled. The continuous contract was rolled last Friday. So if I turn this off, then it looks like it gaps up, but it actually didn't. That was part of the contract roll. And so for the sake of what I want to look at here, I'm going to have this on the adjusted contract. But the problem is the reason why that's the reason why that is not necessarily always great to do is because when you go back across time, it makes it look like, for example, back at the top, if in 2022, January 2022, it looks like the top was over 5,000, and it actually wasn't. So at the time, at least. So just understand that we're looking at this with the contract adjustments just for the sake of a clean chart. So I just want to mention that off the start here. But anyway, looking here at the S&P 500, you could see that we've had a couple of down weeks or a couple of down days this week in a row, starting on Wednesday, and the week is actually down, which is pretty amazing when you consider the price action that we had on Tuesday. Especially Tuesday was interesting because we had a CPI that was on a year-over-year basis above expectation, and the markets didn't care. S&P was up over 1% on the day, despite that. And so it's, I think a lot of people at this point are convinced that the market doesn't really care about inflation. And I suspect that some of that has to do with the fact that the Fed continues to signal its potential cutting of interest rates this year. And so I think that at this point, market participants largely don't care what the data is, because they remain convinced that the Fed will indeed cut basically no matter what happens, because the Fed has almost reiterated that. So I would say that. And yet on the PPI, yesterday we had a down day, and actually could have been worse, but there was if I go to it's pretty ridiculous. If I go to the 1 minute chart, we can look at this. I'll go to yesterday's price action. And I always like to make jokes about this. I'm kind of going off book here, but I always like to post these charts where I say something like equities take the stairs up and the elevator down, or something. And the reason why is because if you look at what happened, it looks better if you look at it. Let's see if I do it like this, because like over the course of the day, you kind of see that the market is dipping over time. It takes forever, has a pretty big rise, and gets back up to the intraday highs almost, and then it kind of comes down, and then just in the last 22 minutes of the trading session, it rockets back up. This was this was 51.88. It ended the trading day just about 52.20. So that was over a 30-point rise on the S&P in 22 minutes. So I always make a joke about that. But like it was down overall on the day, but it could have been much worse. But in any case, it was still down on the PPI, and the PPI was blazing hot. It was way above expectation in every way you could imagine. So that's obviously bad news for anybody who, who thinks that inflation is just going to go nice and neatly to 2%, and that the Fed has clearance to cut. I actually take this. I mean, this is just me pontificating here and doing a qualitative view rather than a quant view. But I think that inflation has already bottomed. Which is not to say that I'm saying that inflation will shoot back to the sky. I'm not calling personally, at least at this point, I'm not calling for, going back up to 9% or even 6% or 5%. But I do think that, and I feel like what I'm seeing on Twitter is this dichotomy between people who think that immaculate disinflation is going to just perpetually continue down to 2%, and people who are talking about inflation just rocketing back up. And it doesn't have to be either of those. So if I pull up my charts, if I just, let me take a look at, let's see here. We take a look at my CPI charts, if we zoom in, maybe I'll try to zoom in a little bit to make this a little bit easier to see. So the top panel is headline CPI, the bottom panel is core CPI. And basically, you can see that the year over year is still dropping. That's not surprising, at least on core. It's basically at the same level as it has been since on the year over year in headline since June of 2023. But what I pay a lot of attention to is the blue bars, which are the 3-month rate of change. And typically the rate of change will tell you the direction that the year over year is going to go, so long as that rate of change is consistent. And so one of the things that you notice if we look down at the bottom panel, which is the core, if you go back to August of last year, the August CPI reading was the bottom in the 3-month annualized, and it's been progressively coming up ever since. And today is the first time, today is the first time in a while that the 3-month annualized, actually the last 2 months are the first time in a while that the 3-month annualized was actually above the year over year, which the rate of change again is telling you direction of the reading. And so you'd be hard pressed to see the year over year number drop if the 3-month annualized continues to increase. And the problem with that is that if we look at the year over year from February is basically 3.8% core. And if the 3-month annualized is higher, it's hard to see inflation going a lot lower than that, at least on a core basis. Now, if we go to the PPI, see if I can find my PPI readings here. The PPI, obviously PPI is all over the place. So the headline has been, basically around the same level on the rate of change with a couple of spikes and a couple of dips since August of 2022. It's been kind of just, you can see the 1 month annualized is like up and down, up and down, up and down. And then you see on the PPI, the core PPI, you can see how that is, has the year over year has been coming down, but the 3-month annualized has kind of leveled and has really accelerated the last 2 months. So that's not good. Again, the whole idea being that market participants largely don't think it's a big deal. And yet inflation is a big concern of the Fed, and I think that the risk is that people are not taking into account enough is that if inflation has not fallen to a good level consistent with the Fed's goals, they won't cut this year, and the market still thinks that there's going to be at least 3 cuts this year. And so that's of concern, particularly for the bond market. We'll talk about the bond market in just a minute. I have a pinned tweet about the greatest risk in 2024 being about bond yields, and I have a section, I went through a whole thread, but I have a section that includes discussion about inflation, among other things. So again, you can find that on my pinned tweet. All right. So speaking of my Twitter, let me go back to the charts here. I want to look at the NASDAQ for a minute because I want to point something out. Last Friday, something happened in the markets that hadn't happened in well over a year. And let me go to my Twitter feed for this. This is some old posts. See if I can find the post here. I put on Friday a week ago, I put, it's been more than a year since the semis had a bearish outside reversal day. And the reason I was talking about that is because I was looking at the NVIDIA chart, which had a massive outside reversal, bearish outside reversal to the downside. And the reason why that was really significant, see here, pull the chart back up, and we'll do the semiconductors SMH. I talked about this last Friday, but I'm pointing it out again because on a huge run up like this, as everyone is getting more and more crowded into the semis because it's been what has been working, this kind of bearish reversal pattern, just a massive bearish reversal pattern, this is like the most obvious sell signal ever. And I believe I reiterated as much last week. This is like, I mean, if you wanted to take a shot at a short on semis and on technology in general, then it doesn't matter if you were talking about QQQ, if you're talking about NASDAQ futures, if you're talking about specifically XLK, the technology sector ETF, or if you're talking about SMH, specifically the semis. I mean, this is, if you took a short and put your stop loss at the high of that day, I mean, that's the most obvious trade in the world from a risk management point of view. And so on Monday in the morning, I tweeted that, something essentially along those lines, saying, I mean, honestly, was selling the NASDAQ on Friday midday not the most obvious trade in the world? So let me go back to the NASDAQ, right? So same kind of thing here. I mean, we didn't have the same type of bearish engulfing reversal that we had in semis specifically, but because the semis have been the leadership of the NASDAQ and because stocks like NVIDIA have such a huge weight in the NASDAQ, this would have been that spot. So you would have put it at the high of the day. And again, and this is, by the way, the reason why the contract adjustment makes a difference, because otherwise this looks like, I mean, it looks like it's barely unchanged after being up really high. But even so, if you took a short here, if you took a short at the end of trading on Friday and put your stop loss at the top, your trade is in profit. And you've almost, not quite, you've almost got a 1-to-1 profit at this point. And so I think this is playing out. I don't think that this is going to be a crash. I'm not calling for, there are people out there who are saying, oh, this is the beginning of the end for the stock market. I think there's a lot of, you could go find some macro people on podcasts and stuff that will explain to you, that can give you a good bull case. There are a bunch of people out there who will give you the bull case. But election year, populism, whatever, this is not going to be, in my opinion, at least until things change, this is not going to be, the crash that everyone has been talking about for, well over a year. And there's no, if I pull up my business cycle indicators, let's see here. Here we go. If I pull up my business cycle indicators from the NBER, other than industrial production, there's really no indication that the economy is going to slow. We still have got sales and spending and incomes at decent levels. So in the near term, there's no risk of recession here. And then if I go find my jobless claims charts here, jobless claims are doing fine, right? No huge breakouts, no huge upswings yet. So I mean, everything is fine, like in the economy. So, you know, what I'm saying is, from an economic standpoint, economic data standpoint, there's nothing fundamental that says this thing must fall precipitously due to, growth scare or recession or anything like that, right? But I do think, my opinion as I look at it today, is that this reversal off of Friday, at least in tech, is continuing to the downside, and this is one of those prove it points. If the bears are going to take this thing down, and if we're going to get a correction, we got to continue to see follow through into next week. Now, the catalyst next week is the FOMC meeting. That's the biggest catalyst. So the big question, the thing that I'm looking for is the Fed going to change their dot plot? Which the dot plot, we can talk all day about the fact that the dot plot is never right, especially dot plots earlier in the year. So like the March dot plot is probably not going to be right because it has not been right ever. But it's not about whether or not it's right in what actually happens, because no one can know an unknowable future. But it's more about the policy stance that the Fed is taking, what they're signaling. So what would not surprise me, I'm not saying necessarily that this is my base case, I'm still kind of thinking about it. It's entirely possible that the Fed could adjust their dot plot either from the standpoint of this year, maybe taking out a cut or two, or maybe all three of them, or taking out cuts in the future. So that to me is the biggest risk as far as markets go next week. We've already gotten the inflation data. We've already gotten, at least on the NASDAQ, the reversal that looks like it's starting to play out. Basically, all we need is for the Fed to not be. All we need. I should rephrase this. All that is needed for the prices to continue to fall into next week and to really get a correction underway would be for Powell to not be dovish. He doesn't have to. He doesn't have to be super hawkish, but if he's not at all dovish, and if the dot plot is different, then this will be a correction, and then the question will be looking for the move, looking for where the move is going to be. So if we do our Fibonacci levels, then there's a couple of different levels that I would be looking at. First place I would be looking at is around the 382, maybe around the 382 Fibonacci level, and then the 618 Fibonacci level. But there are, the easiest way to manage the risk on the downside and try to find entry points. Obviously, use your horizontal support levels, but try those Fibonacci's. They'll give you levels that you could check out. In any case, that's something to think about. Sorry, I just blanked for a second there. But it does, to me, my personal view right here is that this is going to follow through to the downside, which does not mean you should just go running short, because this has been a raging bull market since the beginning of 2023, outside of this one correction that we had in the summer of 2023. So you don't short raging bull markets, right? What you do is, if you're already long, you take risk off. So that would be the prudent thing to do. One thing I want to point out is breadth. Still pretty healthy, but is coming off a bit. I thought the most notable thing was the breadth in the NASDAQ, which is really close to the 50 level. When it comes to the stocks above their 50-day moving average, to me, this is a good proxy for the kind of the more near-term direction. And so if this gets below 50 next week, then I think that the correction indeed will happen. And then at that point, once it falls below, then I'm going to be watching for the breadth, this breadth indicator to get down into the teens. Once it gets into the teens, if we are going to have a correction, that would be one thing I would use to confirm, if we were at the bottom of a move. So if I go back up to, say, my S&P chart, let me go to my NASDAQ chart. We'll do that. So, if we get down, one of the Fibonacci levels was was like right around here. On this chart, it's about 16,200. If I go to the non-adjusted chart, that level's about 15,800. But right about there, let me put a Fibonacci here just so that I can make sure that it's actually, so I can make sure that it's actually accurate. Okay. Yeah, so if I do the 618, so if we were to get down to about 15,800 on the NASDAQ on a correction, and then the NASDAQ stocks above their 50-day average was down below 20, that would be a sign that stocks are getting overextended to the downside, and it would be time to try to go long again. Now that's assuming that what I just said transpires. It may not. So you have to be aware of all the risks. What I did think was interesting today was that we got the last 2 days, today and yesterday, we got pretty significant moves up in the VIX that actually got sold off. So there's not a lot of vol up action going on here, at least in terms of the staying power. Another thing I wanted to point out on this going forward, again, I think this is going to be related to inflation risk, but we got, after last week, it was really interesting. Last week we got a bearish tide cross, and so I thought, oh, I guess this, I was kind of saying, oh, this bullish tide cross must have been a false signal, but then price caught a bottom here and moved back up, and now we've got a bullish tide cross. So now again, I'm back posturing on the side of bonds selling off and yields rising. And of course, yields can rise and stocks can still go up, but eventually you get to the point where it becomes a problem. So we're actually at levels on the yield right now where we were back in August when the market was starting its correction. So that would be something that I would be aware of. And again, now that the yield, excuse me, now that the yield has made a bullish tide cross, my position on this is now that the highest probable outcome is that we actually go make a test of 473 in terms of the yield percentage. So that's what I would be concerned about. And I would also be concerned about the potential of the dollar moving back up, because dollar right now is below its tide line. It never had a bullish cross again, and that's what I was wondering if it was going to happen. But despite the fact that the dollar came off, it does not look like it wants to go down below that. So we'll see what happens if this is just a teeny relief bounce and a continued move down. But I'm going to be interested in watching what happens with this next week, because the tide line and the control line are still close enough together that a sustained move, like a big move to the upside, could get it to cross relatively quick order. So I would be conscientious of that. Let's look at Bitcoin for a second. That's been a big one. Obviously, we made new all-time highs over the last few weeks. And one of the things that I thought would happen originally was I thought we would get a move to the all-time high, and it would not double top in the sense that that would be it and it would go down to 15,000 again. But I thought we would get some consolidation below it, but it just continued to push up. And now on a couple of occasions, we've had big sell-offs and then big recoveries intraday. So right now, it looks like Bitcoin is establishing its prior all-time high as a really, really strong level of support, which had previously been the resistance. And so to me, that's a signal. It doesn't mean that Bitcoin will just shoot to the moon right now. It could consolidate. But the longer that it stays above this level, the more likely it is that it will just continue its move to the upside rather than having a sustained correction. So there's a lot of stuff happening with Bitcoin. Obviously, the ETFs are getting a lot of inflows, and those inflows are leading to purchases. And a lot has been made about how more is being purchased every day than is coming on in supply. And so that's partially, I think, what might be propping the price up. It's totally normal to get a 20 to 30% correction right before the halving. So we're well within that range. And I just keep hoping that, if I go back to, Twitter, my personal position is somewhere around this level. I'm still thinking 20 to 30% down. Of course, I'm okay to be wrong. but I continue to tweet this ever since last week. I keep saying, okay, now can we stay above the previous all-time high? And it just like even when it gets above, it just does not want to keep going. And so I think that that's something to be aware of. But it is, like I said, it is resting on that prior resistance and trying to make sure that it stays support. So obviously, like what I would say with Bitcoin is it's going to go higher in the or in the medium term. So if it goes down 30% from here, okay, that sucks. But then it's going to be up multiple tens of percent higher just after a couple more months. So you just have to be patient on the bull market. When the bull market in Bitcoin and in crypto starts, you pretty much just buy and hold, and then add on dips because it's just going to keep going for a while. And then the last thing I want to talk about is gold. Gold has had a big move. I don't have the chart ready because I don't have the most recent positioning updated, but I did take a look at the COT data, and people have gotten really, really long gold here. Not as long as they have been over the last, not the longest I should say that they've been over the last couple of years, but getting pretty close to that. And so I think the risk here is that everyone is, because of what Bitcoin has been doing and because gold is now in all-time highs, everyone is, I think, longing, like everyone has gotten long gold with the expectation that it's going to keep going. But the downside, I think, to me, is when you look at like gold miners have had a rise, but they largely have not participated in gold's rally. They're still well below their all-time highs. To me, that's concerning. And then I'm going to pull up GLD, which basically follows the price of gold. But one of the things I want to say about GLD is that they've been talking about how there have been considerable outflows in GLD. So I think that, to me, there's concern that people are that gold is this is going to be a fake out in gold. Now, what I will say at the end of the day is, you guys know, if you've been following this channel, going all the way back to April of 2023, I was talking about how all-time highs in gold are going to be a 2024 story. At the time, I thought a recession was going to happen between then and now. Obviously, that didn't materialize, and obviously, much can be made about the fact that there were basically about 2 hours worth of time that I was wrong about the no all-time highs before 2024 thesis. But generally, here we are. I expected us to be, above our all-time high during this calendar year. So I've got no skin in the game on gold right now. I'm just watching the positioning data to see if I can get a sense of that. But all I know is that the data is telling me that there's a risk that gold is just going to come right back down again. So gold may not do anything for a little while, so just be aware of that. And I would finally say on gold, there are too many podcasts and too many YouTube videos where all the guests are saying, oh, nobody's talking about gold. But the problem is if everyone is talking about that, how nobody is talking about gold in podcasts, if everyone in the podcast is saying nobody is talking about gold, then nobody is not talking about gold, right? So it just doesn't make any sense. So just be aware. I don't think that gold has the same prospects that Bitcoin has, obviously in terms of even just general gains. But I just think that gold is due for a turnaround here. And I think that's actually going to be it for today. I'm already at about 30 minutes, so we'll stop there. Thank you for tuning in. If you subscribe to my newsletter, look at that this coming Sunday at 11 a.m. Eastern Time. Obviously, if you subscribe to my newsletter, you get much more detailed insights, as these Friday videos are just my quick recap and quick look at the markets in real time. On my newsletter, I actually get to go through my full research process before I publish anything, so go ahead and check that out. And with that, I'll let you go. Thank you for tuning in. I hope you guys have a great weekend. I'll see you guys next time.